Okay, welcome to our webinar today. The topic you see there is what you should consider when trading the new normal. So when it comes to the art of trading and investing, whatever the new normal looks like, the fundamentals have not changed. And that is my main focus today of this presentation. A lot of us think this time it's different, but the fundamentals have not changed. So you need to think beyond today, no matter how volatile it is. To consider the long-term trends that will shape the world we live in tomorrow. Okay, we'll talk about some of these trends. Some of the questions that you should be asking yourself include, what will happen in the next 5 years to shift markets? What are the mega trends you should be considering when investing? And what sunset industries should be avoided? So talking that in that way, you need to take a long-term view of South Africa. You must also establish not only which industries have attractive fundamentals, but obviously which ones can survive a watershed decade of economic policy turmoil. So those of you that logged in late, my name is Shaun van den Berg. I'm an investment specialist here with PSG Wealth. My objective today with this webinar is to discuss why the new normal does not change the fundamentals of investing or trading. Okay, so, oops, let me just move this out the way. Cool. Okay, so those who came on late, this presentation is being recorded. So any questions you have, there will be a place where we'll ask questions, but type any questions you have in the question box as we go along, and hopefully as we go through the presentation, I'll be able to answer it. So my agenda for today very quickly is what you should consider when trading in the new normal, how to invest in some of those mega trends, and there are many. I'm going to highlight about 6, and then touch on very, very briefly market and limit orders, and end of the day, and good for to trade, good for to cancel orders. There's been a lot of confusion with our traders regarding that. So let's get into the nitty-gritties. Okay, so the first thing I want to bring up is what you should consider when trading in the new normal. The one thing is certain, we know that adjusting to change can be challenging, but be it planned or unplanned, gradual or sudden, change is inevitable, a very much part of being human. So over the past few months, we all experienced an unprecedented shift in our way of life due to this COVID-19 pandemic. Pre-pandemic, who would have thought that toilet paper would have become as good as gold? Okay, and now a trip to the weekly grocery store, the Pick and Pays, is an adventure on its own. I, for one, I'm one of those people that still work from home, and I hardly ever venture out. So when I do go to Pick and Pay, it is an adventure for me. Okay, so when society does start going back to normal, call it normal, there will still be obviously restrictions in place, but we are facing fundamental shifts in the way of our life. So what does a new normal look like? So first of all, according to Wikipedia, a new normal is a situation or a state to which an economy, society, etc., settles following a crisis, when this differs from the situation that prevailed prior to the start of the crisis. So we've been through a few new normals before, believe it or not. The term was used back in 2007, 2008 with the financial crisis. It was used again in the aftermath of the 2008, 2012 global recession. And obviously now it's come really to the fore with this COVID-19 pandemic. So what is the new normal? Obviously it's affecting the way we live. It's different. So we've seen already with masks are commonplace. We have to wear masks. They're commonplace and mandatory. Same with hand sanitizing and social distancing. We have this curfew. Breaking curfew, by the way, could result in a 3,000 Rand fine, while failure to wear a mask in public can cost 1,500 Rand. And fines may also be accompanied by a jail sentence, not exceeding 6 months, and criminal records could obviously await those found guilty of flouting lockdown rules. Interesting times we live in. Secondly, obviously queuing is a new normal. Going to the doctor or even going to some of the shops, sometimes you have to stand in a queue. They only let a certain amount of people into the establishment. Even going to a lift. Getting to a lift nowadays is quite interesting. We do a double take whenever we hear someone's cough or sneeze. I've seen that so many times. You get these dirty looks from people. Uh, but also, what I personally hope from all this coughing and sneezing that where we have these double takes is that we have higher standards of hand cleaning and personal hygiene going forward. You can see number 4 there. We will holiday more in our backyards due to travel restrictions. I was one of those people that stayed home in December. I would love to have gone down to Mschlange, but yeah, my holiday was cancelled and we stayed home. So things like that will change, and we're seeing already with international travel with regarding a vaccine passport. So there'll be a lot of people not traveling internationally again. Small things like that make up our community have changed. We see it already with school sports. We see it already with community. Gone are the days you can just go to the local cafe and hang out with your friends. Things like that have changed also. I think larger sporting landscape has also changed. I was looking at recently the Currie Cup and also the Proteas playing against the Sri Lankans, and I was very heart sore to see the empty stadiums. So it must be also difficult for these sporting guys to be playing in a stadium where there's no fans pushing you on. We've seen also with the Summer Olympics happening, was supposed to happen last year in Japan, being pushed to July this year. So things like that are affecting a lot of things. Okay, so that is how we live. We also see things, the way we study, work, and invest has also changed. The schools nowadays, education, as we know, has changed. The universities and schools are moving to online training. Some are blending face-to-face with obviously online lectures. Universities, for example, also around the world are feeling the impact from the absence of international students, and conferences will be paused. International collaborations and sabbaticals now look very different to previous years. Work has also changed, as I mentioned just now. I'm obviously working from home still, and obviously the whole idea is to minimize traveling and getting groups at the office. So we all know that Zoom and the Microsoft Teams meetings has become our new normal. And then also when we look at the way coronavirus has changed the stock market trading in the foreseeable futures, investment strategies need to reflect the markets that's scarred by this crisis. I don't know if some of you guys know that early May last year, legendary investor Warren Buffett dumped his entire holding of US airline stocks, booking significant losses and claiming the world has changed. Air passenger numbers have been growing by 5% a year before coronavirus pandemic, but yeah, the stage of Omaha basically said that this is not business as usual. So not everybody agreed with him. Obviously, the feeling is the governments wouldn't let airlines fail. We know that very well here in South Africa. Airline stocks have enjoyed extended bounce backs after previous financial crisis. So we hope that history gets repeated. But we shall see who wins, who's right. But you can talk to anybody. They had a portfolio of, you can see here on the right hand side, a portfolio with shares like Comair, or shares like that have exposure to the hospitality industry, be it Sun International, Douglas Sun, City Lodge, or even the food groups, the restaurant groups like Famous Brands and Spur. And you'll find that all of us that had exposure to that were feeling the pain. So the big thing here is consumer confidence. Will consumer confidence be will it improve? So only time will tell. So saying that, here's a little graph I took us 2 days ago on Monday. This is the JC All Share. You can see this is we had our little correction last year, March, where the markets went crazy, and since then the market has recovered. So talking about the recovery, some analysts anticipate a U recovery, some anticipate when I say U recovery, the letter U. So it'll be this, as you're seeing here, bit of this will be a V, but this will be a long-term recovery. Some people anticipating an L recovery. So it'll be this fall and then flatlining for a while. And you'll see a lot of stocks are doing that. We're still trading way below. This is the 50-day and the 200-day moving average. many stocks are trading below its 200-day moving average, so they're still in a bear trend. But you can see here we've gone up above our previous high. So yes, this is a recovery. But saying that, investment strategies must take into account not just the obvious winners and losers from the pandemic, but also the changed reality of global business. And we were talking about global markets just now. Regardless of the shape of the recovery, there may be no going back. Okay. So, as I said just now, the fundamentals have not changed. Here's a quote from Peter Lynch: know what you own and know why you own it. So there are certain things that won't change over time. Number one, obviously the role of time. So before I get into that, let me just clarify something. What is a fundamental? Fundamental, it's a central or primary rule or principle on which something is based. So investment fundamentals have not changed. Okay, so through every negative economic or market cycle, we are told it's different this time. And given reasons that each period is unique, one thing these time periods have in common is they are unique. There will always be reasons not to invest. Through these times, remember that the fundamentals of investing do not change. So the role of time, before you start investing in anything, you need to set your financial goals, and linked to your financial goals will be your time period, your time frame. So, for example, if you want to save for a deposit for a house, that would be a short-term goal. If you're planning for retirement, that would obviously be a longer-term goal. So once the goals are defined, obviously, then you need to find the best investment vehicles for you to achieve your goals. Secondly, obviously, we see there your investment time horizon impacts your risk and returns. So we always talk about the risk and returns, the two, call it the consideration of relative risk and the consideration of relative return. The challenge of that, when you find these two approaches, is that there's no consideration of time, number one, and number two, risk is always defined as volatility. So by virtue of these two seemingly inconspicuous assumptions, many investors can be led astray. So let's say, for example, you have 20 years left before retirement. Okay, in this scenario, risk is perhaps not short-term volatility, as we've seen now the last year. A year is short-term, but rather the risk of not saving enough for retirement or outliving your capital during retirement. And last year, November, I did some presentations on exactly that. And then obviously the earlier you start, the better. You can take advantage of the magic of compounding, and your investment, your returns get reinvested, and obviously you can build up a faster or bigger investment portfolio using that. But the main thing is investing is for the long term. And that's what a lot of people, especially when it comes to times of indefinite uncertainty, your priorities may have been reordered. Some of us might have held off on our family holiday. Maybe you've decided to hold off on scaling down your home. There's also always you want to think short term when it comes to things like that. So this is where I encourage you to maybe talk to a financial advisor regarding your investments, especially when the emotions are running high. Speak to a financial advisor. You can look at your investments objectively and give you much better advice. Okay, so there's a quick little, I took us out of a presentation or out of a newsletter I saw this morning. This is from our monthly Insight newsletter. You can get it on our website. Came out this morning, and this is written by our Chief Investment Officer, Adrian Pusk. There's over 25 pages, but this gives you a quick view of the last few quarters going forward. And you can see the view there on equities going forward. Local, they're very positive, and amber, they're cautious on overseas equities, and we'll be touching on it a bit later. But I don't go too much into this. I suggest is when you do get this presentation, just click on this link, and you'll be able to download this presentation to give you more insight. Okay, so how to invest in mega trends. So first of all, what is a mega trend? Mega trend is defined as something that's sustained macroeconomic forces of development. These trends affect business, economy, society, cultures, and personal lives, thereby defining our future world with its increasing pace of change. and I'll be touching on some of the examples just now. Megatrends have diverse meanings and impacts for different industries, companies, and individuals. So this is just very broadly just introduce the concept. We talk about sunset industries and we talk about sunrise industries. Sunset industry is something that you want to be avoided. It's an industry that's in decline when it has passed its peak or boom periods. These have existed for a long time, are less successful, are making less profit. So, for example, those of you who have been around a long time, would remember the analog recording technologies for recording audio and video. Okay, well, those equipment is still around, and sales have been declining and things like that. But you get to that, we can talk about technology, how technology has evolved over time. So those of you that remember the good old cassettes, and as I say, the vinyl records, remember the time when it was replaced by CDs, the compact discs, and obviously those are also going out of fashion nowadays. Nowadays, everything's going digital. Okay, so that's an example of a sunset industry. So many countries will try and protect their domestic sunset industries. So obviously, we see in the States, steel and shipbuilding are now designated as sunset industries. Oil and gas extraction, although they're important still in the economy, they're seen as a sunset industry in the United States. Closer to home, you can call the mining industry as a sunset industry. When I say that is that if you look at some of the criteria around sunset industry, job creation, contribution to GDP, things like the productivity worldwide, we see that mining is on the wane. There's decreasing profitability and things like that. Okay, so that's a sunset industry. So those of you that had mining shares in your portfolio, you need to realign or think about, call it sunset industries. Okay. Then we talk about a sunrise industry. This is obviously the opposite, shows hope of a rapid boom. Anyone who follows technology stocks are familiar with some of the terms. We talk about innovation. So they'll have a high degree of innovation, high growth rates. There's numerous startups. There's a balance of venture capital being thrown at them. So there's a lot of buzz, and there's obviously a lot of interest from investors. We saw way back in 2003 alternative energy, believe it or not, so far back. Social media and cloud computing as far back as 9 years ago. And there's a lot of new, we talk about the FANGs, we talk about the Facebooks, the Amazon, Netflix, and Google. Those are called the FANGs. That's the acronym for the big tech stocks. Recently, Goldman Sachs believes that FANG is losing its bite. They talk about FAMG, FAAMG, and they include even Apple now. So we're talking about Facebook, Apple, Amazon, Microsoft, and Google. So those are the big techs. So those are just some of the trends that have been happening over the last few years. We could also talk now about hydrogen fuel production. But what is it, the 6 big trends I want to highlight today is what they call sustainability, the automation, healthcare, the changes in the healthcare sector, revolutionary technologies, as we're just talking about now, fintech and education. There's a quote there from John Naisbitt. It says, "We are draining information, but starved for knowledge." So some of you might have known about these mega trends. You just go Google mega trends and can do further investigation. This is just 6. There are many more. So we talk about sustainability. So some of you might have heard of the ESG investing. ESG stands for environmental, social, and governance. Obviously, a lot of investors and consumers are both beginning to reward companies with products that solve sustainability problems. Some of you might have heard of SRI investing, which is social responsibility investing. Basically, that's more based on beliefs or values and religion. So some portfolios will exclude things that have exposure to alcohol or tobacco or gambling, etc. So that's what they call SRI, social responsibility investing. But ESG investing, it's very, very, very prominent. And going forward now, we see climate change back on the agenda big time. So alternative energy, we talk about energy, we're talking about hydrogen, as I mentioned just now. There are a lot of companies involved in hydrogen fuel cells. We talk about the old technology, be it solar. Water is going to be a big problem for a lot of countries. A lot of countries are running out of water. I was quite interested to see that South Africa has over 10 desalination plants along our coastline from Lambert's Bay on the west coast all the way up to Richards Bay. There are 10 desalination plants. Although they're not cheap, but the technology is changing. I see there's even solar desalination plants now. And then also going with the energy, obviously the batteries. We talk about the fuel cells there, lithium and cobalt commodities. Any companies involved in that will be in demand. So that's quite interesting. And then going forward, obviously automation and autonomous vehicles. We're seeing already with the Google cars. So the next step now is obviously legal implications. And if everybody's working from home already, that will have impact on urban planning, but also with these cars. Now you're sitting in the back there reading your newspaper, it's also going to take some planning. When it comes to healthcare, it's obviously a more efficient use of data and sharing of data along everybody. You can still keep your medical history private, but they want to share the data. We're seeing a lot of smart watches are getting onto that space. Be it Apple, the Apple watches, smart watches, or even with the Android watches. And then the revolutionary technologies, and this is where I personally find a lot of interest, is the virtual reality, VR, augmented reality, where the artificial intelligence, 5G, and then also the Internet of Things, or smart things, as they call it, on Android. We'll talk about some of those ETFs that are aligned to that. Now, on the fintech side, I find there's a lot of information available internationally, but here in South Africa, I find we're very slow. So the tech giants like the Apple and Google are creeping into the online payment space. We find more on the wealth management side. There's advisors being used more often. And education, we all know that the education system does not prepare people for the modern job market. So there's a lot of changes happening there, and especially with technology. Technology is helping a lot of people with opportunities to tailor the teaching methods for each student. I personally use a lot of Udemy, the short courses on Udemy, Coursera. There's a lot of courses there too. Okay, and I think that's going to happen. More and more people doing short courses to get practical experience. Okay, so yeah, just to highlight for you, some of you might have heard of the ETF from Signia called the Signia Atrix, the fourth industrial revolution. You can see the share code there. This is a screenshot I did this morning, and you can see from that low of last year, March, okay, till now recently, this ETF has gone up 142%. You can see also it is very overbought. You can see on the MACD. But you can see what makes up the stock, what's involved in the ETF. We have a company called Vuzix, although they have a small percentage in it. Vuzix is one of those companies involved with the design, manufacture, marketing, and sale of augmented reality, basically the devices that are referred to as head-mounted displays. So this company itself, this share, Vuzix, over the last year has gone up 716%. Okay, so 716% the last year. That company there, Blink Charging, as you would realize, it's involved in the electric vehicle sector. That share has gone up over 3,000%. We all know about Tesla, but anyway, you can see what kind of stocks is involved with this Signia Atrix ETF. You can buy that on the local on the local share trading account through PSG Wealth, and there you can get some more information about it at the bottom here. And then I had an interesting call yesterday from a client that's interested in offshore investing, specifically in the offshore ETFs. He highlighted this ETF for me, ARK Innovation. Again, it's got Tesla in it and things like that, but some very interesting companies, especially involved with as I say, the hydrogen energy, a lot involved with the labs, a lot of generic stuff going on there. But these are two ways for you to get involved with exposure to these mega trends. Bottom line, when it comes to mega trends, combine fundamental, quantitative, and technical analysis with a dash of common sense. Okay, all these companies, by the way, involved with these mega trends are very overvalued. There was an article today's Business Day, for example, about ESG investing, and today's Business Day highlights how overvalued these companies have become. If you look at a company like Naspers, has got a PE ratio, price earnings multiple, of over 50, whereas Prosus has got a price earnings multiple valuation of over 65. So yes, they are great growth companies, but they are seriously overvalued, and same with all these companies. So they had a good run. As I said to this gentleman yesterday, if you're going to go rush on to buy it right now, you're buying at the top of the market. I'd wait for a pullback, whether these shares become more undervalued or not undervalued, where they pull back on profit taking, and then I'll consider slowly increasing my exposure to these kind of shares. Okay, so guys, basically that is the presentation. So I just want to quickly highlight for you two different things that's coming up for a lot of our traders. What are market limit orders? We've simplified the placing orders quickly. A market order is a buy or sell order that's executed immediately at current market prices. Basically, you're asking us a question, I'm willing to buy and sell at any price. That's when you use a market order. Okay, just understand that your priority is to execute the share, execute the trade. That's what you want to try and do. You can see there, market order. So ideally, I like to link it together. Market order is going to, at 5 o'clock when the market closes, if it's not met yet, it expires. Okay, so that's a market order. When it comes to limit orders, okay, remember market orders, you want to trade at the price, ongoing price. Limit orders, you are stipulating the price, and this is where a lot of people are getting things a bit mixed up. They assume if I put a limit order in, that automatically will trade. No, there's no guarantees. Okay, so remember the market, you want to buy a share, you need a willing seller to agree to your price. Okay, so don't just assume that your share will be traded. It's not guaranteed. Okay, so just always be careful there. So that's why I suggest when you use the lifetime, always use good till cancel. So until such time the order gets matched at your price, or you physically go and cancel the order, use good till cancelled. So talking about that, what is the end of the day? So if the order is not matched, by the end of the day, it expires. Okay, so if it's not transacted or filled, you need to re-enter the next day. So at 5 o'clock, it expires. Good till cancelled, GTC orders, as I say, it will stay on the system for at least 3 months. If the order is not matched, it will stay on the system unless you also come back and cancel it. So that's very quickly on highlight those two things for you. Okay, so guys, I'm on time still. So quickly summary, this COVID crisis has changed a lot of things for a lot of people. But the main thing I want to highlight for you guys was the fundamentals do not change. You know, health is wealth. That's a new throwaway phase a lot of people are using, but it has a new significance and resonance after the year we've had. The impact of the coronavirus pandemic has been significant. It has challenged how we think and how we operate. Many of us now have a great appreciation of factors such as health, our relationships, and obviously time. And many of us are looking at wealth creation in a starkly different way. So these are lessons from the chaos that we can use to do better now that we know better. So just to reiterate again, every once in a while, here's a quote from Jim Cramer. So every once in a while, the market does something so stupid, it takes your breath away. So you can look at it with a ghost and say, wow, what's happened? Or you can say, okay, this is going forward. This is what I'm going to do. So yeah, we can see again, those fundamentals do not change. Okay. So my point on I make of this presentation is, don't change your portfolio radically. Still have a good balanced portfolio, call it that, but research some sunrise industries and have exposure to some of those ETFs, both local and offshore. So here's a quote from John Templeton. The only investors who should diversify are those who are right 100% of the time. So those of us that are just public, diversification is key. Okay, it is necessary to structure portfolios in such a way that they can deliver in a wide range of market scenarios. Okay, so those of you that do not have an equity account with PSG as yet, just click on this little link, gives you some more information about our local share portfolio. And those of you that have that are interested in offshore, have exposure to those offshore ETFs, they can go get some more information there. So this webinar, as I say, is being recorded or should be sent out either by late afternoon tomorrow or on Friday morning. I'll also be sending you the PDF. But any questions you have, I'm there to help you. Okay, before we touch the questions, this is how you can get hold of me, either through our wealth box, our wealth at PSG, or 0860 000 368. Okay, so just quickly look see what questions you guys have put up here for me. Okay. Hello? No questions. Okay, that's one question, yeah. How can I gain exposure to the ETFs mentioned? Well, obviously the Signia one trades on our local JSC, so you can open up a local equity account of us and then have exposure to that. There's a whole range, there's about 94 different funds you can choose from. You can have exposure to a whole market or to specific shares. Okay, same with offshore. We have about 1,700 shares on our offshore list, and you're going to gain exposure that way. Will this webinar be recorded? Yes, it will be recorded. I'll be sending you the presentation as well as the PDF. How can I get hold of the ECSG article you referred to in the business day? I'll be sending you the link. Okay. How do you invest in ETF, Celo? Yeah, as I say, you can open up a share trading account with PSG, and through the share trading account, they trade exactly like a share. You'll be able to gain exposure to the ETFs. But Celo, I'll send you some more information. Okay. Cool. Are there any other questions? All good. Awesome. Thanks. Pleasure, Celo. Guys, thanks a lot for being on this webinar. Until next month, keep well, stay safe, and bye for now.